let's talk a little bit of physics. Physics first. What does Albert Einstein say the strongest force, most powerful force in the universe is? Does anybody know? Anyone? Not gravity. Compound interest. Okay, perfect. So I've got some gold to give away, so you can come up and get this free gold back after the talk here. Compounding, the most powerful force on the planet. So why don't we bring that into our investing strategy to take advantage of it? Well, we do. I'm going to show you a strategy called an asset reinvesting strategy called the adaptive compounding strategy. And by doing this, we can avoid disaster, we can protect our lifestyle, and you can generate higher growth or more annual income depending on what stage you are in life here. So I was fortunate enough to semi-retire at the age of 27. I've just been managing my own money. I share what I do with subscribers to my newsletter, but it wasn't easy to get there. I blew up 3 trading accounts. I've lived through a bankruptcy. So I learned lessons very young, very early, swinging for the fences. As we all know, if you got a smaller account, you usually swing pretty hard to make some big gains. But I have a very good lifestyle now. I've got my daughter, Mirabelle, my wife, Kristen, my son, Ben. We love to travel. We've got a pretty good thing going on, and it's all because I took a lot of beatings early and learned some lessons sharp when I was younger. So the strategy I'm going to show you here is called an asset reinvesting strategy. This is where we take our money, we reinvest our capital into the only asset that is performing best at any given time. We hold one asset class at a time. This is different. This is not like the buy and hold. We don't diversify. There's always one asset class that is better than something else, and that's what we move into. So we are going to be walking into one of these soon, potentially any day, to be honest. Can somebody tell me here, what is worse than a 50% drawdown, a loss, losing half of your wealth? Does anybody know? Pardon? It's on the chart. It's on the chart. No, time. Wasted time. We can all make money back, but I want to show you how we can take advantage of a rising market and a falling market and not waste 13 years. The NASDAQ took 16 years. I'm going to show you how we can take advantage of every wave of this. So what if I told you there's a way to identify when we're in a bull market and a bear market? There is. It's not very difficult, although people think the financial system is difficult and complex. Prices usually go up or down. If you look at it, it has wave-like patterns. I am a surfer. I live on the water. The ocean is the best analogy. When the stock market or when the tide goes up, what happens to all boats? The stock market is the exact same. There's a time to own stocks and there's a time to own no stocks. And so knowing that kind of powers the whole philosophy. That's the same for all asset classes. Now in 2001, back then I learned about fundamental analysis. All I did was own the strongest companies that had quarterly growth, quarter after quarter. Yet I pretty much blew up my portfolio because the stocks just fell in value, 50 to 70%. That was when I realized fundamental data, news means absolutely nothing. Price either goes up or down, and it's just a matter of are people interested in buying it or not. It doesn't matter about the fundamentals. So if we take a look at what happened last year, the tariff crash. Our strategy went from green bars saying own equities, the NASDAQ here, to get out of stocks. So we moved out of stocks. We owned another asset that went up in value as the market collapsed. And then we were able to buy back into the stock market as our strategy said, hey, this is not a bounce. This is actually a new trend starting. We use about 12 different data points that tell us when the cycles, the money flow, the sentiment has shifted, and we can move back in a lot of cases at a lower price, buy it back cheaper. COVID, the same thing. You'll notice these charts all look almost the same. Doesn't matter if it's a huge bull market or bear market or a news-driven type of event. Price does one of two things. It goes up from greed. People see opportunity. They want to take risk. Or it goes down because they're scared of something. It doesn't matter if it's a tech bubble, financial crisis, tariff news, or a global pandemic. Price does the exact same thing. So don't pay attention to fundamentals or news because it'll get you on the wrong side. It'll spark your emotions, and you'll make probably some pretty expensive mistakes. So if you only hold assets going up in value and you step aside when they're not performing, you end up with this adaptive compounding strategy equity curve, which is a nice, steady, slow grind. The strategy that I shows about 5 to 12 waves that roll through the markets every year. We put those on with simple ETF trades. Imagine having a whole bunch of small, high probability wins that compound on top of each other every year. So instead of compounding your growth once a year, you're compounding it multiple times a year. And the nice thing is they're high probability trades with low volatility, meaning it's very stable and it goes up. Doesn't matter if it's financial crisis, flash crash, COVID, 2022, baby bear market that we had, we can just keep grinding out gains. So let's talk about the realities of investing, trading, and retirement. If you're a buy and hold investor and you're retired, you probably have gray hair because you will never retire early buying and holding. It requires 30, 40, 50 years. You're going to have dead decades where there's no returns. Lost money, then you got to claw your way back. If you're an active trader, there are numerous studies in North America, South America, Asia. They all show the same thing. 93% or higher of active traders lose money or underperform. Trading more doesn't mean you make more. Maybe more fun, adrenaline running, but it is not a good strategy. And then the biggest and scariest piece is 81% of, this is an American study, 81% of retirees are expected to run out of money in retirement. And that is the thing we don't want to happen. Nothing worse than retiring and then scared to spend your money and go do stuff. So how do we go about doing this? Let's look at it from a technical standpoint. This is pure price action. We follow price. This is where people get things wrong. A lot of people get into technical analysis like I do, and they try to predict highs, they try to pick bottoms, all of that stuff. It's not about that. It's about following price. Wait for a trend to happen, follow suit. So the 4 stages are stage 1 base, steer clear of them. They're dead, they're choppy, they're unpredictable. They can last a decade in some cases for some assets. Stage 2 is a bull market. We're almost always in one. It gives this false belief that investors who are doing really well have their accounts hitting all-time highs. It makes them feel like they know what they're doing, they're a good investor, but they get their head handed to them when we hit the next phases. Stage 3 is a topping phase, the market. That's where we're at right now in equities, the economy. Precious metals is kind of in that big peak right over there, but we'll touch on that in a minute. And then we go into a stage 4, which is a bear market, financial reset, collapse, crash, whatever you want to call it. Life-changing, either for the better or for the worse, depending on how you attack it. So this is what the price chart looks like when you break down. So the stock indices themselves convolute the picture, but when you break the markets down to a small sector or an individual commodity, you can see those 4 stages. It's an emotional phase. It's an emotional cycle. And this was the ARC K ETF. Did anybody trade this back in 2020, 2021, the ARC? There we go, nice. Yeah, so it's a roller coaster ride. It fell 81.5% and it has not recovered. You need to know when to step aside. This is the emotions that anybody who traded or anything that's gone through these cycles goes through. The left side is the side we all like. Who doesn't like belief, thrill, euphoric phase? I want to show you guys how to replace anxiety, denial, panic, and depression with the left side. So we love the side going up, and in some cases, a lot of us actually love the downside even more because we can make money from falling pricing. Pricing falls 7 times faster than it goes up, and it gives us more money to invest at the beginning of a new bull market to make really easy wealth for the next 5 or 10 years after that. So when people go into anxiety, it's a lot of people holding on to positions. They're like, I don't want to give back anymore. I can't believe this is starting to go down. I can't afford it. Price starts to slide a little bit more. Then they're like, I can't believe how much I'm down. And they always say the same thing. I hear it all the time. I'm just going to have to ride it out. Problem is, the next phase of stage 4, when we do go into one, price falls so fast, day after day, people see their life savings vaporizing. They hit the trigger point where they're like, if the market falls 5 or 10 more days like this, I'm going to have nothing left. My life is ruined, my retirement's ruined, and they panic out and they go into a depression. So we can turn anxiety into optimism because we know what's coming. Denial into belief. Yes, we're in a bear market. This is a correction. It's going to be ugly for most people, but not for us. Panic. It's a thrill. And then, of course, the bottoming phase is kind of euphoric. It's kind of like taking candy from a baby. It's volatile, but it's pretty easy to make some money when the market is collapsing. So let's look at it from a bigger standpoint here. Precious metals. tend to perform very well during a stock market high. Check, we got that. Silver is going ballistic today. I talked about if 106 is broken on silver, it's going to go to 120, 140. It's going to go into the euphoric phase, and it did that yesterday. Broke 106, and now we're like 120 as of like an hour ago, something like that. Energy stocks are at all-time highs. We got war. We got countries being taken over. We got chaos. Nobody believes in, everything's just crazy right now. And then capital, industrial goods, companies are upgrading their businesses, their equipment. They don't realize we're walking into a big storm here and they're going to have low demand. So let's look at the gold chart. This is the monthly chart of gold. There's two blue boxes. The first blue box was 2005, 2006 time frame, 2007. We saw gold trade sideways. Nobody really wanted it. All they did was buy stocks, real estate. And then suddenly gold took off in 2007. And that was the warning sign. Gold and silver are the global barometer. It's like the world is a hive mentality. When gold and silver take off, it's like somebody kicked the hornet's nest, and now it's unsettled. And it usually tells us something big and bad is brewing. And then we had a financial crash. Stocks fell 50+%. Gold fell 34. Silver fell over 60. Fast forward to the next blue box. We just had many years where gold went nowhere. Everybody bought stocks and real estate. We got bubbles in those again. Now precious metals are taking off. They are screaming. If we were in a horror movie and everybody's screaming at the character like what to do, like this is the warning sign. The end is coming. The music is about to stop. Silver is the perfect gauge here. 106 is the target. Once we blow through that, it's a technical level, a Fibonacci level, that once you break through there, it becomes an emotional move after that. And we've been seeing this coming for months. We've been talking about this, and we broke it, and now it's unfolding. And so now the question is, where is the top in gold? Where is it in silver? I think gold will correct 30 to 40%. I think silver will correct 50 to 60% once it puts a top in. We don't know where that is. We're in bubble territory. You got to feel it out. Got to scale out of positions. We actually closed some of our gold position today, just to give you a gauge of how we're starting to lock in our profits, protect our capital, protect our lifestyle. The next is the economic and business cycle, the innovation and adaptation phase. Every time we have a new bull market, there's something new that changes kind of the world. AI was it. Long story short, it spurred on business, dragged the stock markets higher, so it kind of kicked the can down the road and stretching things a little higher than they really should be, I think, in terms of equity pricing. We are now in this $1 trillion IPO frenzy, where the sharpest minds in the world, the biggest companies, are racing to go public. Every time we have seen this going back 100 years, the biggest companies in the world start to go public. At the same time, there is a big ending to it, a painful collapse of the economy. So this is another one of those warning signs. And the last one here to just touch on is the Benner cycle. This is Samuel Benner's back in the 1800s. The middle line is where cycle highs can happen, and the top line is another one. When a cycle tops at those lines, he says to liquidate assets of value. Lock them in because we're going to have a correction. He's called the tech bubble, the 2007 market top, the COVID peak, which even says at the top it can even have pandemics. Of course, in the 1800s, it was probably more common to have those. But the next cycle high is 2026. So it's interesting that this guy's cycle is coming to play out at the exact same time, and all of the analysis, I'm just showing you snippets of what's happening. There's a lot more, but I'm just showing you the big picture stuff. You need to be prepared because right now we're probably the richest we've ever been. But if you're not careful, you will go back a decade worth of hard work and savings in months, potentially. So how do we do this? Through an asset revesting strategy. Has anybody read any of my books, Asset Revesting or Technical Trading Mastery? You have? Which one have you read? Technical Trading Mastery. Great. Okay, I have a gold back for you as well. Thank you. All right, so asset revesting. Let's take a look at how we do this. I got limited time here. It's following an asset hierarchy. We want to trade whatever's highest on the list when it is in an uptrend, which is equities. It has the most volatility, the most potential to make money. Then we'll move to bonds, the dollar, the inverse dollar. So if the US dollar is falling, we can still benefit from it. Or we go to a cash position, which is bill. You just get paid daily interest or a monthly dividend. This is how we navigate the markets. Equities, bonds, and a type of cash position. Those are the biggest markets. We can move in and out, blink of an eye, not affect anything. This is how we walk through COVID. The top chart is the SP 500. Our strategy gave us a red bar saying get out of stocks. We exited stocks. We moved into TLT, which is a bond fund. It rallied 19% in 9 days. It gapped above our 15% target. We actually got out of bonds at the ultimate high bonds have ever reached. We were richer than we'd ever been while everybody was losing their shirts. And then we moved to cash, and we could focus on our health, our family. COVID was fresh and new then. And then a few weeks later, our strategy said, hey, this bounce in the stock market is now a trend. The money flow is pouring back in. Everything was saying to get back in. So we hopped on and we rode it up to all-time highs. So we just stepped through the markets. It is not complicated. It's very different. It's so simple it feels wrong. And it's like watching paint dry. As a lot of my subscribers say, it's like, this is pretty boring. It's the same thing every day. We got 5 to 12 trades a year. Sometimes less is more. Simple, keep it really simple, and that's what I focus on here. So if you were to take like a buy and hold strategy, the buy and hope strategy, which is a ticking time bomb, if you're retired and you have the buy and hold, man, you have your life at risk here right now. This is a 10-year window, just showing you what happened with $1 million portfolio. You pull out $50,000 a year, subsidize your retirement a bit. After 10 years, you still have $1 million. If you do the strategy that we share, which is the adaptive compounding strategy, you end up with a lot steadier returns, bigger returns, and a way bigger net worth at the end. And you did it with very little effort. And you can sleep better at night, and it gives you tons of time to do stuff because you're not glued to the screens, you're not an active trader, you're just following the market. So that's kind of it. I'm out of time here, but I believe now is the time to protect your capital. Everybody I talk to is talking about how much money you're up. It's amazing. You wake up this morning, you're up hundreds of thousands in precious metals. It's insane. It feels like free money. Easy come, easy go, though. Protecting your wealth is number one. That's what I focus on. I'm not here to make maximum returns. I'm about steady returns and sleep better at night and do other things you love, family adventures, stuff like that. So anyways, that is it for me. If you like what I do, you can join my group. There's a group of us, it's $3,000 US, but we are in a community. We trade together. I share my portfolio, my exact trades. We do all this stuff together. You can learn. You can have it auto-traded for you, all kinds of stuff. We do mentoring sessions every other week. It's a lot of fun. It's a great community. So anyways, hopefully you guys got a little bit of insight. At 2:20, I'll be on with David Rosenberg in Studio 3. We're talking gold and silver in more detail. So anyways, appreciate it. Thank you very much.